FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. I'm Kerry Lutz, and today is 9/10/2020. Well, a lot of movement in these markets. We've got 2 steps forward, 1 back in the stock markets. Gold, silver were really appreciating well, and now have had a bit of a consolidation period. Slight declines. Well, where are they going to go? Oil back down below $40 the barrel. What about interest rates? Where are they heading? All these markets. And when we want to know, we want to get some insight into where the markets are heading, we always turn to Eric Hadik and Eric's site, which is Inside Track Trading. That's inside with 2 I's, INSIIDE, tracktrading.com. And Eric's made some uncanny calls on precious metals the past few years. So it's great to have you back on. And any questions, I'd like to know your opinion on where you think these markets are heading. Just email us, kl@kerrylutz.com. Eric, great to have you back, and thanks for coming.
Well, great to be back, Kerry. Thanks for having me back.
Hey, so the markets have been a bit volatile lately, but I don't know that we talked since the crash in mid-March. But if an outsider, if you're just looking at numbers and not looking at charts, you would think that pretty much market started close to where it is today. And now we're in the 9th month and nothing's happened, right?
Right. It would look pretty much like a sideways market if you didn't see what happened from February through about June or July. But I think there's certainly some serious implications of that moving forward. And it's also been very intriguing to me, and I'm sure this would come off sounding a little too esoteric or a little too strange for a lot of your listeners, but it has been remarkable to me, and I've discussed this for a couple of years now, but how closely the market action, or at least the swing points and the moves in between, maybe not the magnitude of each of them, but how closely the stock market has paralleled what it did 2 years ago, that there's been a very consistent 2-year cycle that I've talked about since late 2018, and also what it did 40 years ago, just mimicking this 40-year cycle in the markets.
Yeah, that is interesting. And just tell us again, refresh our recollection, where does the 40-year cycle come from, your work on it?
Well, that's certainly a time frame and a number when you get into, and again, I'm not going way into things like numerology or anything like that, but 40 days, 40 years is a very common cycle. It is a cycle that you can see cited and adhered to going back thousands of years. You can certainly see it recounted over and over again in the Old Testament and New Testament of the Bible, and not necessarily, you don't even have to look at that as a spiritual application, but a physical one. 40 days, it mentions in the book of Exodus that that's the time that the Egyptians embalmed their dead. And, today people say how remarkable the embalming of the mummies and whatnot was. And here, so thousands of years ago, this 40-day cycle was recognized, and an overlapping 40-year cycle. So it is certainly something that has been, again, it's through many historical documents. You'll read things, even if they're not necessarily ascribing it to a 40-year cycle, you'll hear them just kind of enumerate different events, and and 40 years later, this happened, which, surprisingly was kind of similar to what happened 40 years earlier, or maybe 80 years earlier when you go through a multiple of that 40-year cycle. And it's just something that I think you risk your own peril by ignoring it, since it is something that has governed life, and even more in the last decade or so, they've discovered. I also watch the sunspot cycle, which is approximately 11.2 years. But what they have determined is that there is a much larger and more significant cycle on the sun called the Great Conveyor Belt that has to do with the movement and rotation of the storms on the surface of the sun, and it's a 40-year cycle that this Great Conveyor Belt of the sun is what they call it. So, if it's something that's there and present in the center of our solar system, then it's something that most likely is going to impact life here on Earth.
Right. And so we look back 40 years ago from this year would be 1980. What was going on in 1980? Well,
and that's the thing, too. Before even discussing that, I will repeatedly kind of stress, warn, put it into context that in most cases, I am not looking for any sort of precise repeat. I'm more of the mindset that history rhymes, but does not repeat, that you often get a sequence of escalating events on a 40-year cycle, which doesn't mean that the current time frame is exactly like 40 years ago. But in this case, coming into 2018, there were so many corroborating events, fundamentals, and cycles and technicals in the market that what I described right from the start of that was that I thought 2018 through 2022 would look remarkably similar to 1978 to 1982. And I listed the specific things that I was looking to see some similarities. And even in the midst of those similarities, there's stark differences. One is that in the late 70s and into 1980, you saw the culmination of a kind of long period of inflation in the markets, in metals and commodities, and that final phase was a real blow-off. Whereas this time around, I thought that 2016 through 2020, 2021 would see a major up move in precious metals, and towards the end of it, you'd start to get some inflation in commodities, which I thought we would start seeing from March of this year through May of next year. But that could actually be the onset of a broader period of price inflation, as opposed to 40 years ago when it was more the culmination and we went into decades of kind of deflating commodities, even though inflating paper assets. So there's those type of distinctions too. But getting back to specifically 2020 versus 1980, even as we came into the year, I did several reports in late January, early February, citing the 2-year and the 40-year cycle, but also that it was triggered more by a very consistent 8-month and 16-month cycle in the stock indexes and a lot of weekly and daily patterns that were setting up in mid-February, that I thought we would see a sharp correction and that it should bottom between March 18th and March 23rd, which is exactly when the Dow set its lowest close on March 23rd 2 years ago.
I know.
The 2-year cycle. And the Dow set a multi-quarter low in the week of March 23rd to the 27th of 1980. Sure enough, we plunge into March 23rd this year and bottom in perfect sync with both that 2-year and 40-year cycle. And when I was looking at the 40-year cycle, I described how from that point forward, the market actually worked higher into late August through late September before it then went through a very volatile period. And so I was looking for the same thing this year based on a lot of other things as well. I really emphasize synergy. I'm not just going to look at one or two cycles or events and base my expectations on that. It took a lot of corroboration for me to come to these conclusions, but that we would see something very similar to 1980 where stocks would recover and even head up to new intra-year highs leading into the period between late August and late September. And if you look back at 1980, from that point forward, we saw a lot of volatility, sharp swings down to new multi-month lows, and then a few weeks later, back up spiking above multi-month highs, and a few weeks after that, back down to even lower lows, kind of what Elliott wave technicians would call an expanding triangle, a megaphone. There's all different technical terms for that type of pattern. But it wouldn't surprise me at all to see something similar with the election that we have coming up. And you can be sure there's going to be dramatic swings in sentiment and expectations, and the market will probably be swinging with that.
All right. And that is really interesting that it repeated itself 2 years apart, because we saw those lows, March lows. So March is becoming like a month where bad things happen, kind of like September and October, huh?
Yeah, and that was really when I started discussing this 2-year cycle, was back in August of 2018, and I did a couple of reports just on that cycle. And at the time, what I was pointing out is that if you went back in 2016, 2014, I think it was 2010, I believe it was 2012, was not quite as consistent with that. But because there was even some very strong similarities 2 years earlier and even 2 years prior to that in 2008, it was certainly something that had caught my attention. And I described how in many of those years you started out with a sharp drop into January or February, like you had seen in 2016, and then you also saw it in 2018. And then the markets worked higher into September, October period, and then you saw a sharp sell-off. And so in August, September 2018, I was describing how, along with a lot of other technicals, I was looking for a sharp sell-off in October through December of 2018, which was, again, similar to the previous period on a 2-year cycle dating back for the previous decade. And so that 2-year cycle has continued to govern some of these broader swings. And it's not precise. You can't go back and look at 2 years ago and say, oh, the market has to do this because it did it then. It's nothing. There's certainly more of a nuance to it, but it's more the important swing points and the movement of the trends in between, and then honing that with current specific analysis and technicals. But again, back in 2018, we worked higher into late August through late September. One thing that I was just putting in my weekly thing back on September 2nd, I issued a couple of publications saying that a market top was imminent. We were due for a quick, sharp sell-off. If you go back to 1980, the Dow had 2 sell-offs, one in August and a second one in early September, and it bottomed on September 9th. Well, here we are. We just saw a sell-off into September 9th.
Yeah.
And I was discussing with my readers why there were other reasons also saying that we could see this quick, sharp sell-off into the 9th or 10th and then see a rebound. But the other point that I was making here is that in 2018, the NASDAQ 100 set its highest weekly close during the very end of August. And so last week on September 2nd, I was saying to my readers, okay, the NASDAQ could be in store for the same thing, but in order for that to happen, it needs to have a pretty sharp sell-off on September 3rd and 4th, because it would need to close lower on the week than where it had closed the previous week of August 28th. Sure enough, we get this sharp sell-off led by the NASDAQ, and right now, the late August weekly close is the highest weekly close, just as it was in 2018. And in 2018, you had certain indexes working up to new highs throughout September and even a couple of them into early October, while the NASDAQ was kind of bouncing off its highs and just making this double and triple top up there between late August and early October. Then you saw a sharper sell-off in October of 2018. Well, here we are repeating that part of the pattern again after bottoming in March like we did back then in the Dow, working higher into late August, early September. And so there's a lot of similarities, but again, you have to be very aware of the distinctions and differences as well.
Yeah, so history might not be exactly repeating, but I'm hearing some very strong rhymes here, Eric.
Exactly. I couldn't put it better.
And so let's look at some other markets. So you're thinking that we could very likely see a strong downward movement in the stock market in October? Is that what you're saying? If the rhyme comes true?
Well, that would be, when you're talking about compared to 2018, but some of my overriding work tells me to look a little bit more at the 1980 parallel, where you see this whipsawing, quick, sharp sell-off, then all of a sudden a strong rebound. Once we get through the first half of October, then I should have a better idea of what the extent of my expectations are. But again, I don't look for it to repeat verbatim or even close in most aspects, but there are some very important and very revealing clues that you can glean from those previous cycles.
Okay. Of course. So that's going to be interesting to see. So what about looking at precious metals, gold and silver in particular? I don't know if you do any work in platinum or not, but I'd be curious if you do.
FSN Radio. It's all about what's next.
Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. At Silver One's Candelaria Mine project in Nevada, there is already a historic resource estimated at 127 million ounces of silver, which Silver One is developing and advancing. The company's Phoenix Silver project, located within the Arizona Silver Belt, is an early-stage exploration project on which native silver vein fragments have been discovered near surface. One grab sample assayed an astounding 14,688 ounces per ton. Yes, that's right, ounces, not grams. Silver One has tremendous exploration potential, is extremely leveraged to the price of silver, and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com.
The Financial Survival Network. It's all about what's next.
I do follow platinum more on a broader, weekly, monthly basis, and some of that had turned negative not long ago. I thought we would see some selling into probably mid-September, but moving to gold and silver. This is definitely a critical time for me based on longer-term cycles as well as intermediate cycles. And since late 2015, early 2016, and then I really stressed this in late 2018 when I did some reports on the mining shares and gold and silver stocks as well as the metals. And then finally kind of reiterated all this back in March when silver was signaling a major bottom. But my longer-term work has been saying to look for, particularly where gold is concerned, a move up into late 2020, and the two important cycles that I've been focused on for 3 or 4 years now is September, October of 2020, and then April, May of 2021. And from that distant vantage point of a few years ago, when you're looking at cycles like that, it's kind of like, looking at a pair of mountaintops in the distance or something, where you're not even sure which one's higher than the other and what type of valley there is in between. And that's kind of how some of this forward-looking cycle analysis is, that you could certainly determine these key time frames and even the magnitude, that being high or low, the magnitude of the move expected during those cycles, but it doesn't always determine, for instance, whether the September 2020 peak is going to be higher or lower than the April-May 2021 peak. And that's where other things need to come in and hone that analysis. The cycles, especially the longer-term ones, are more just setting the stage. They're a backdrop, and then a lot of things need to be filled in from there. So the point I'm making is that we're in the process of coming through one of those two critical cycles when I thought some important tops would take hold in gold and silver, but they haven't really revealed to me the extent of what I think will be a sell-off from these peaks, and then what to expect from in late 2020 and early 2021. So with those kind of limitations explained up front, I do think that gold and silver have fulfilled even some lesser, that being weekly, monthly, and even some daily cycles, and fulfilled some key upside wave objectives and other technical tools, with gold actually setting a peak in early August, and then silver, which since March has been and expected to be the stronger metal as these inflationary forces continue to grow. But both of them are fulfilling this cycle high, and I think that we could be entering a period where you're going to see more corrective / consolidation moves in precious metals for a couple of months.
Interesting. So some consolidations in the metals, and that indeed is what they've been doing since like early August, right?
Yeah, and I think that gold probably has a second sell-off in it, that it could take it down to 1,800, potentially down to 1,700 if, depending on how this next wave down unfolds. And silver has some key targets down around $22. So they're the initial objectives to the downside. That doesn't guarantee that they will be the bottoms. It's more of a case of, okay, that's what we're looking for right now. And as we get closer to those levels, then the market usually reveals what it's going to do at those points. So it'll be interesting to see if a sell-off does materialize. Particularly, I'm watching the time frame on either side immediately surrounding mid-September. But if we get a sell-off between now and then, it'll depend on what occurs during that sell-off, whether more technical damage is done or it remains in more of a corrective type of structure that then would, ultimately lead to a new advance. Interesting. So it's a little too early to see, but your gut feel tells you that it's going higher, or what are you thinking? I definitely think I still have these expectations for an inflationary environment stretching out into the second quarter of next year. And that, as well as the cycle lows that silver fulfilled back in late March, have me pretty convinced that silver is certainly going to see another nice up leg between now and then. But that obviously, like I was just describing, that also includes at least one intervening correction here, and perhaps more than one along the way that are of significant magnitude. But I do think that silver's heading to higher levels on a couple-year basis, and that gold probably would as well. But it is one thing where since March, silver has been the one that has certainly gained on gold. The gold-silver ratio has really narrowed since that bottom, and that was really what was expected in a price inflation environment where it's not as much safe haven buying that is driving metals as we've seen in recent years. And when that happens, gold benefits far more than silver. Sometimes silver even suffers if the fears have to do with economic retrenchment. But this time, I think it's more of an inflationary basis, which is going to be linked to multiple things. All of the massive spending that's had to be done, dealing with COVID and other challenges of the last year. As well as the dollar weakness that has begun to take hold again. So there are those corroborating factors that also are pushing towards more of an inflationary type of. And it was interesting to me after I've been saying this since late March. Then all of a sudden you get Fed Chairman Powell a couple weeks ago coming out and announcing this dramatic paradigm shift in their viewpoint that now all of a sudden a little bit of inflation is a good thing and almost a necessary thing. And to me, that was also another reinforcement of this 40-year cycle where exactly 40 years ago we're having Paul Volcker, attack the evil of inflation and that pretty much has impacted the mentality of the Fed for 40 years, and now you get this sudden paradigm shift when the evils of deflation are more in their face.
Right. And yeah, so inflation, we've had this long multi-generational decline in the rate, or at least it didn't go up much. Even when it did go up, we've even seen, my test is the cost of a Thanksgiving dinner, which for the past few years has been going down. So now you see the inflationary trend reversing?
On a limited basis and more of a, specialized as far as the markets that it's impacting. In fact, just recently, the Goldman Sachs Commodity Index got up to some critical resistance that I thought we would see for the first leg. So we're kind of into a decision point here where it wouldn't surprise me, and this kind of goes along with the correction that's been expected in precious metals and energy markets, and I think some of the commodities are getting near important tops, like in the grain markets. But I think we will see a second leg take hold a couple months down the road from now. And again, it's certainly not. I'm not talking about the type of inflation that people think about in the late 70s. This is more something that's a bit more targeted and limited in scope.
So it's not going to be bordering on everyone thinking hyperinflation, which is what people talk about most. Weimar Germany, Zimbabwe type inflation.
I'm not looking for that at the moment, but we'll see what the next couple of years bring.
Interesting. So with that, inflation, interest rates, where are we heading there?
Interest rates have been, while being a relatively boring market for several months now, and I'm referring to 30-year bonds and 10-year notes, which are the the futures markets that I really focus on the most. Boring, but also very cyclically consistent. And for the last 2 years, since late 2018, all I kept focusing my readers' attention on was mid-2020, June, July 2020, for the next, what I believe would be a multi-year peak in bonds and notes. So that is, they're the inverse of the actual interest rates. So it's a multi-year low in rates, and it also involves perception of rates. That, the markets really are driven by perception, not always reality. So just because bonds top and start to sell off doesn't mean that the rates are necessarily picking up upward momentum, but rather the perception has shifted, that no longer are traders looking out 6 months and saying, oh, rates need to keep going down. Now they're kind of shifting that mindset and saying, oh, rates are stable and maybe down the road they will tick up a bit. That's what really drives the markets. It's those future expectations. And with that said, I thought and still believe that the middle of 2020, which fulfills a very consistent 4-year cycle in bonds and notes, it governed successive lows in the 90s and early 2000s, and then it inverted to governing successive highs, which is exactly what I expect from cycles. I have a cycle progression tool that kind of explains that and shows why cycles do that. But so it had timed successive highs, most recently in June, July 2012, June, July 2016, and I was looking for something similar in June, July 2020. So far, we have our highest weekly close at the very end of July 2020, and those markets starting to roll over. And I think that this topping process is going to continue to unfold, and we're going to see bonds and notes steadily roll over, and then at some time in the not too distant future, then you prepare for more significant sell-off, which would be rates or perception of rates ticking up. And that may be with this next phase of inflation that I expect. If we do see something in the beginning of next year, that maybe some more dollar weakness and maybe some more supply disruptions with key commodities and other economic factors that just start to bump up inflationary expectations, well, then you get the interest rate reaction to that as well. So the two outlooks could go hand in hand in the first half of next year.
Very interesting there. Very interesting. And then you mentioned the dollar, and no conversation between us would be complete without your take on what's happening with the U.S. dollar.
The dollar has had a really consistent, it's about a 3.25-year cycle, 38, 39 months. Sometimes it expands to 40, 41. Sometimes it narrows to 34, 35 months. And that's why you also need more specific and more precise tools rather than just those general cycles. But it has had that very consistent cycle, which had me looking for a important top in March, April of this year, 2020, which was 3.25 years from the December 2016, January 2017 peak. And from there, I thought we would see a sell-off into the first quarter of next year, 2021, which would be similarly about a 3.25-year period from the low that we saw in late 2017, early 2018. But also that would, if we do, and we're starting to see it, but if we get continued selling into December or January, it would also fulfill a more consistent and somewhat politically related cycle that I talked about back in early 2016. And I did a series of articles then before you even knew who the Republican candidate was for president. They were still going through, the campaign cycle and debate cycle. And what I explained in these articles was that all my analysis was telling me the dollar should peak at the very end of 2016, early 2017, and then enter more of a corrective phase. Prior to that, if you looked back for 40 years at each administration, you saw a very consistent pattern where during Republican administrations, you had a weakening dollar, and during Democratic administrations, you had a strengthening dollar. And so my analysis back in early 2016, which was saying we should see a peak in the dollar and then a multi-year corrective phase to follow that, was leading me to believe we would have a Republican in office in 2017 and moving forward. And the reason I mention that now is, so we got that. The dollar peaked exactly, during inauguration and whatnot of a Republican administration. And you saw an initial sharp sell-off for a year. And then the dollar has been recovering since then. But if we could see another sell-off here and make it down to lower lows than we saw at the end of 2017, beginning of 2018, then basically what you've had is a downtrending dollar through this entire administration, which is consistent with that pattern. And there are some fundamental reasons for that. You go back to even during the Reagan administration and when James Baker was hitting the airwaves all the time, talking down the dollar. There is a kind of a mentality of trying to increase export growth as a result of that. That's how, just very generally speaking, Republicans tend to view the dollar and Democrats a little bit differently, but there's a lot of other factors that's extremely overly simplified. But it's what you've seen. And again, all you have to do is go back and look at a dollar chart for the last now 45 years, and you'll see that consistency. And that also does make me wonder, although I certainly want to look more at my longer-term outlook in the dollar beyond early 2021. But if the dollar is going to bottom in early 2021, and if this pattern holds true, what does that mean for the next administration? So, it's some intriguing things about the dollar, but for right now, I think we're actually going to see a bit of a rebound here, and that's also one of the things that could help pressure gold in the immediate future. But then I think that the dollar is going to see another wave down in the fourth quarter of this year and then stretching into the first quarter of next year before it bottoms. And that would also go along with gold and silver heading back up, even though it's rarely a perfect 180-degree inverse correlation between dollar and gold, despite what so many traders think and expect.
Yeah, correct. So do you think the dollar is saying that Trump is going to be reelected?
If my analysis is correct and we bottom out, and if that pattern remains true of higher dollar during Democratic administrations, it would actually be hinting at just the opposite.
All right. Well, hey, we will see.
Yeah,
we will see.
I'm certainly not comfortable going, with any conviction going on that, and that has nothing to do with any political beliefs one way or another. Just this pattern that I have seen in the markets, and in this case, in the dollar.
Yeah. So it might happen, and it might not, or there could be other circumstances that could cause the dollar to strengthen, even though might not be cognizant of them right now. I guess we've given us a lot to chew over here, Eric. I think we'll call it quits for now, and let us think this through. And we'll talk to you in a month or two, maybe right after the election, and see what happens then. In the meantime, you want to go take a look at Eric's site, InsideTrackTrading.com. That's inside, INSIIDE, tracktrading.com. And ask away any questions you might have. Email is kl@kerrylutz.com. Twitter feed @KerryLutz. Facebook page, Financial Survival Network. Of course, don't forget about our contest. We're giving away a half ounce of gold. Go sign up now. FinancialSurvivalNetwork.com/contest. Eric, we'll talk to you again real soon.
All right. Thanks for having me back, Kerry.
FSN Radio. It's all about what's next. Go to FinancialSurvivalNetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.